Hello from Core Wealth. We're going to be looking at what has happened in the month of March and the first quarter of 2024 in global and local financial markets. March was a really positive month, a lot of positive sentiment in global equity markets, particularly in the developed space. We saw that the first quarter of 2024 was the best, or the fourth best quarter in the last 30 years for developed markets equities. On the interest rate side of things, we've been talking a lot about interest rates. Central banks have not started cutting interest rates yet, the big ones anyway. And so we've seen the US, the UK and European central banks still talking about reducing interest rates, but not having started as yet. On the geopolitical side, the risks in the Middle East and in Russia and Ukraine have spurred the gold price up to an all-time high in the month of March. And then lastly, the Magnificent Seven, as they've been called, the seven big tech type stocks in the US have started to see perhaps some changes in their returns. Some of them continue to grow, things like Alphabet, but during the month we saw Tesla, or for the year to date, Tesla down almost 30%, Apple on the back of some antitrust fines that it received, and also it pulling out of the electric vehicles market, its share price coming off somewhat during the first quarter of 2024. So on the South African side, some of the news that came out, the economic growth numbers came out for the last quarter of 2023, up about 1.4% for the quarter, which was about 0.5% ahead of what the market was expecting. So that was good to see. And we ended the year of 2023 with economic growth of about 0.6% for the year as a whole. Not at the level that one would want it to be, but a good recovery following a really tough start in the first half of 2023. The South African equity market did very well in the month of March and was kind of the class leader relative to its usual peers in the emerging market space. This was on the back of a lot of the resource and mining type businesses on the JSE doing very well, as we saw some of the commodity prices rising. So this next table just shows global markets in US dollar terms over different periods, and you can see the results of what I was mentioning in the early introduction. Developed market equities doing really well both over the month, lots of green for the month, but also if we look at the last quarter, which is year to date, and the last year, developed market equities up 25% over the last year, and a lot of that coming from the US and Japan in particular, both of them getting close to 30% up over the last year. If we look over the longer term, developed markets have definitely been the place to have been, especially the US, and not far behind the US has been Japan as well. China has struggled, and emerging markets have weighed because of that. But this is a big question at the moment. There's some good value being offered in a lot of the emerging markets. In other words, their shares are cheap, and we expect that you could be well rewarded in some of those sectors into the future. Let's have a look for local South African investors, what our markets did in South African Rand terms. You can see that the month was a nice positive one for South African equities, up 3.2%, clawing back some of the losses that had happened in January and February. And resources turning around was a tailwind behind that. The Rand, interestingly enough, strengthened a little bit during the month, between 1.3 and 1.5% against the other major currencies. Over the longer term or medium term, listed property doing very well over the last 3 years, and listed equity now just below 10% over the shorter time frames, and still room to see further improvement in the South African listed equity markets. So let's have a look at how our different strategies done versus their peers. We'll start off with our global US dollar strategies, and here you can see versus peers done very well, lots of green shading. These strategies have been running since November 2016, and since inception, returns of our growth strategy, for example, just over 7.5%. That's 1.3% ahead of the peers, and we're very happy with that kind of outcome per year. Interestingly, over the last year, you can also see that some really strong returns coming through in the last year. If you were in our global growth strategy in US dollars, your assets would have grown by 15.7% for the year. This next slide has a look at our younger models, which are the UK sterling based global models, so still investing globally but with more focused on a UK sterling investor. And you can see over the last year, again in absolute terms, some nice returns, slightly behind our peer group in the balanced and the growth strategies. But if we look at the longer term since inception, which in October will be 3 years, we can see some healthy performance ahead of peers, which is really what we're trying to achieve, in addition to getting good returns, which in the growth strategy in pounds, over the last, since inception, you'd be up just over 7%. If we have a look at how the South African-based rand-denominated strategies have done, we can see in this table one or two spots of red over the last year, but not really big numbers. Some slight underperformance there. Most importantly is when we start looking at the medium and long term, consistent outperformance by most of the strategies versus their peer groups. If we look over the last 3 years, for example, some of the more longer term focused strategies like our balanced retirement growth, flexible strategies, all giving you just over 4% better than inflation returns. We still think we expect better returns than that into the future if we look at current valuations in markets, but still some healthy returns ahead of peers and ahead of inflation. Now we're going to have a look at some of the highlights and key points from our finance minister's budget that was held towards the end of February. In this slide, we break down a number of the key measurement factors in the budget, but probably the most important thing that we've seen now in the most recent set of results is that the government achieved a primary budget surplus for the first time since 2008. That essentially means that their expenditure before interest was less than their revenue that they received. So good, reasonable revenue collections, but they are starting to clamp down more and more on the expenditure side of the budget, which is a good thing to see. In this chart, we show you the budget in a nutshell across the last 2 years and then what it's projected to be. And importantly, they're aiming to get the budget deficit, in other words, their shortfall after all of their expenses, down from the current level around 4.9% down to as low as 3.3%. And that is an improvement on their last outlook that they had in October last year. So the next couple of slides, we're going to have a look at how this is going to be achieved, how this lower deficit is going to be achieved. This slide just looks at the economic growth projections. So are they being reasonable in their projections for revenue growth? And in short, we do think they are. The graph on the left just shows how that's changed through time at the different budget speeches. And then importantly, the graph on the right just compares it to growth projections from the Reserve Bank and from Nedbank as a private sector economist, and we can see that their numbers are not really out of line. In fact, we've seen some economists having higher projections for economic growth, so we're quite comfortable with their outlook. Another area where the government can get additional revenue is in how it changes taxes. This slide here just shows the different areas of tax collection, and one of them is something called bracket creep, which essentially just means they don't move the brackets of the tax rates, and because most people's income will increase through time with inflation, you end up moving into a higher bracket, which means they collect more revenue. And the second last line of that table shows you in each year, and over the 3 years that adds up to some 55 billion rand. The other thing that's in here that has not been changed is the general fuel levy has been kept stable, and therefore no additional revenue is expected from that line. One of the challenges our government has is that its debt servicing costs, the interest it pays on its debt, is a large proportion of its overall budget. It's trying to keep that below 20%. For many years, as you can see in this graph below, our debt servicing costs as a percentage of GDP, the orange line, has continued just to go up from sort of around 2008. what the aim is and what we're seeing in this budget, we're seeing that that line is being flattened out. And that is a good sign that ultimately they want to try and keep our debt servicing costs below 20% of the budget. And the graph on the right just shows you how that's flattening out over the coming years. It's going to be a challenge because to do this, it needs to rein in its salary costs as a percentage of its overall expense bill. Having mentioned that employee compensation is a large proportion of our budget, you can see that in this slide. Compensation of employees making up 31.8% of the budget, and debt servicing costs in the 24-25 years makes up 16.1%. So those are two things that really need to be controlled. On the right-hand graph, you can see how those different expense areas are expected to increase or decrease in the coming years. And we've spoken about debt servicing costs, but the compensation for employees being budgeted at around 4.5% into the future. We think that will be a good thing if that's maintained at that level, but that may be a challenge for government, and how adamant they are and how successful they are time will only tell. If you follow the budget, you may have heard of something called JAFECRA. Now, that is really just a reserve that is on the government's balance sheet that they haven't accessed in the past. It's quite normal that they can access these things. These are reserves that are based on the gold and foreign currency that they hold. And this slide just shows you how that's going to be released. The red line just showing that they're expecting in the 25 and 26 and 27 tax years to be releasing 150 billion, which again will go to reducing debt. The little table at the bottom just shows you there that essentially that will reduce the level of debt as a percentage of our GDP by about 0.3% a year. So this isn't something that is strange. Many countries have done it around the world. It's not something that happens frequently, but it is something that one can use to minimize the debt that a country has, which is a good thing, we think, for South Africa. So the budget as a whole, we think, was a good one. I've heard another analyst say at one stage that the adults are in control when it comes to the Department of Finance, and I think we've seen that again here by how this budget's been put together. The government does need to hold its line though, and that's really the big question as to whether it will do that on some of the expenditure lines. That concludes what we want to talk about today. If you've got questions, as always, please give us a call. We'd love to have a chat and take you through any of our thoughts on those things.